All right, good morning and welcome back to the Money Advantage podcast. Today we're really excited to have a conversation with you about your questions. So, we've done these kind of episodes in the past where we've brought questions that have been asked on YouTube or Facebook or in meetings that we're having as we're talking with people who are interested in implementing infinite banking or people who have questions about the economy or how to navigate specific concepts and ideas. And while this particular episode today is not necessarily geared towards your specific situation and giving you specific advice, I just want to be clear about that. You would need a separate meeting for us to be able to understand your situation and be able to advise you directly. There are questions about the workings of finance and concepts of finance and the principles of finance and why we would choose to advise one thing over the other, or why we like a certain thing, or whether you have questions on the structure and the design of infinite banking, um, of policies, of whole life insurance policies that are designed for infinite banking, or whether you have just questions about money in general. We'd love to be able to be a solution for you. And I just want to take a moment as we're getting started on this episode today that I just want to thank you for being a listener and a subscriber. We really, really value our audience and our tribe. And I want to tell you how much we value you because we create this content for you. I mean, if you were not listening, if there was nobody finding our work, we would not have a reason to continue to share this with you. But the reason that we keep doing this is because people are asking us questions and we want to be able to provide that the clarity to make decisions and help you be able to have an understanding of whether it's infinite banking or whether it's finance in general, to be able to get into a position of control so that you can make powerful decisions for your future and your family's future. So we're going to go ahead and jump into some of those questions today, but I just wanted to let you know in advance, the format is that we're going to bring some questions that have already been asked, and these are questions we're not going to share the name of who has asked them. We'll just kind of go through some of these. They cover a wide variety of topics, and so we're going to be all over the board today in terms of what we're covering. And I want to invite you that at any point that you're listening, if you have a question, please go ahead and drop that into the live chat, especially if you're watching on YouTube or on Facebook. We'll see those questions and we can bring those into the live show today as well. So you can participate in this format as much as possible, and we would really invite that. So thank you for being with us on this journey, and thank you for being with us on this episode today. So Bruce, anything that you want to share before we jump into the actual questions?
Well, our listeners, if they're listening live, obviously know that this is the day after the election.
Yes.
And for people that aren't listening live, this is the day after the election in 2024.
Kind of
And
a
what I
monumental
find,
time.
what's that?
Kind of a big deal.
Yeah. And I was telling anybody that wanted to listen to me that, I really didn't care who won because I was going to take control of my own financial destiny no matter what. And I think that's a good kind of concept to think about because we've talked about educating yourself to the point where you become your best financial advisor that you can actually be. And I think this is part of the process. That doesn't mean you don't need resources, but it does mean that you should take responsibility. And Nelson Nash just discovered the concept or put guidelines around the concept of becoming your own banker. And the more I've been doing this, I think your own may be even more important than banker. Um, because what ends up happening, I found, is people say uh, when they're trying to build wealth and they actually use a financial consultant or financial advisor or financial planner, whatever you want to call it, they say, "Well, tell me what to do. I really don't know anything about this." Whenever somebody says that to me, I tell them I'm glad you have that trust in me, but we are going to educate you. And so that's why we hit the infinite banking concept a lot, but the behavior of how you handle finances is much more important than the design of anything that you do, especially a policy, or what you put your money in. I'm not saying that's not important, but your behavior your consistent behavior is much more important than any kind of product or design that you put your money in. If you can consistently save money for the future, even if it doesn't get a rate of return, you're going to be better off than if you had not done that. I mean, it's
Mhm.
pretty obvious, but people don't think about that. They're always looking for the magic bullet.
Bruce, I love that you shared that. And I think, I mean, maybe people were waiting with bated breath for us to comment on, the trajectory of the economy and what we think is going to happen based on election results. And what is really interesting to note is that we've been saying this through, I mean, we haven't been podcasting from the Great Depression, and we haven't been podcasting that long ago, but we have been podcasting through economic positive times and downswings. We have been talking through the COVID timeframe, and we've seen downturns, and we've seen interest rate changes, and we've seen a lot of things that people have gotten scared financially in multiple different scenarios, in multiple different seasons. And at the same time, the same habits, the same discipline, the same mindsets of taking ownership and control really will help you rise to the occasion and do the most with what you have, regardless of the environment that you're in. So you get to set your own environment, I guess, is really the key. You're not just depending on the outside environment, you're creating your own internal environment. I was just thinking about Becca Wilhite and the Beaver Bankers book, as I was saying, the environment, and realizing that that is what we do with infinite banking. She equated being an infinite banker to being a beaver and setting up a dam and creating a reservoir and creating an environment. And that's exactly what happens when you take control of your financial life. So shout out to Becca there if you're listening. So all right, Bruce, let's go ahead and jump into these questions. And I might change the order a little bit, but let's start at the top from one of the questions that we had really recently. And this is about how to fund a life insurance policy, or the type of premium, the way that you're getting premium into a life insurance contract. So the question is, does having a lump sum help accelerate the option of having the policy self-sustaining in terms of the dividends and earned interest covering the annual cost of insurance and the base premium? Now, that is a very thoughtful, very intellectual, very um, philosophical question, but it also requires the asker has a pretty expansive understanding of infinite banking. So I think probably a few things would be really helpful to at least explain what some of these things mean as we're uncovering the direct answer to this. So a lump sum would mean one payment into a life insurance contract. So a lump sum is a all at once payment versus having premiums that you pay on an annual basis. So that's what they're asking about, a lump sum. And then having the option of having the policy self-sustaining. They're talking about in terms of the dividends and interest. Those are two forms of growth that happen to your cash value. And Bruce, you can elaborate on any of this, but just for the person who's not as familiar, dividends, well, interest is something that you earn as a guarantee. Dividends are not guaranteed, but it is the proceeds and the profitability of the insurance company that are returned to the policy owner in a mutual company. And those are credited to a properly structured whole life insurance policy. And so he says, in terms of the interest and dividends, or dividends and interest, earned interest covering the annual cost of insurance and the base premium. Bruce, I'll let you cover cost of insurance, but I just want to mention base premium. What he means is the premium that goes to covering the base policy, which is the required premium. In addition to base premium, you will usually have in a specially designed whole life insurance policy, you will have base premium and then you'll have paid up additions. And that is a separate kind of premium that is placed into the policy for the purpose of building a death benefit and building cash value that is a portion of your death benefit.
Yeah, this is you were very complimentary that this person knows a lot, and I would agree with you, except sometimes you can't see the forest for the trees. And this person has what I would call a little bit of knowledge, which can be dangerous, especially if you only hear it from one or two sources. Because, and also, I believe they, just to clarify, I believe there's two possibilities of what they mean, although they do say base and well, they do say base, so I presume they also have an understanding of PUAs, but I'm not sure if they mean one single premium and never paying anything else, or do they mean one single paid up additions on top of a regular policy. So to do one single premium at the very beginning, where you just do base and then a single premium, um, the possibility of that mecking is very, very great because what they're trying to, it sounds like what he's trying to do is saying, can we then surrender what the PUAs bought in that situation enough to pay the annual cost of insurance and base premium? And by the way, those are not different. People try to separate them. It's an earned interest covering the annual cost of insurance and base premium. The base premium is paying for the cost of insurance. Well, what I think he means is that in the future, then can we use the dividends to pay the base premium, or she,
I
whoever
think,
this is?
yeah, I'm not sure if it was a gentleman or a lady, but yes, I think I mean, this is how I was seeing the question. If I pay one premium all at once, I've got a big chunk of money. If I put that straight into a policy all at once rather than spreading out the payments, I'm interpreting. I'm clearly interpreting. This is not their words, but what I think they meant was I've got a big chunk of money. I want to put it into a policy. Will I have more likelihood of the policy lasting long term if I just chunk all that cash in year one into the policy and then use the dividends to continue paying my base premium in the future? So
Yeah.
that's what I think they meant. They could have meant something a little different.
Yeah. So let's focus on that right now. The possibility of that not becoming a mech is almost zero. Um, Especially if you're going to utilize the policy, which is the whole purpose of setting up a specially designed whole life insurance policy with the intention of becoming your own banker, because you're going to become your own banker. You're going to take policy loans. Immediately those policy loans are going to lower the death benefit, and now you're going to have a lower death benefit to sustain, that would have to be that will not be able to sustain this big premium at the very beginning. It may last for 1 or 2 years. And yes, you're going to get some dividends. They're going to buy some more paid up additions, except those dividends are a one-time payment also. So it's not going to buy very much death benefit. And people say, well, why doesn't it buy very much? Well, you're only making one premium payment. And so it's not going to stay in a situation where the death benefit is going to be higher or high enough to sustain a non-MEC status, because the MEC laws actually are a 1 year rule and a 7 year rule, a combination of those two. So it's very unlikely that this will actually be able to sustain itself. So that's an easy answer, I think. It's a very unlikely that it'll sustain itself. Now, let's go where I think, because I've encountered this with people, getting on our calendar at the Money Advantage. And a really big thing that's going on now is people think they found a magic bullet, and they cite all these, supposed gurus that say, oh, Nelson didn't do this, but this person has figured out if you put a single premium on top of your ongoing premium, which is base and PUA, that will then give you a jump start at the very beginning for your cash value.
Okay, so to be clear, what I think you're saying is this new design is let's just make up some numbers. Base and PUA of, I don't know, base of 10,000, PUA of 40,000. So that's 50,000 going in each year, and that's ongoing. But on top of that, you're saying another bigger PUA that's one time on top of the
Very
50,000
good.
premium. So maybe that's like 200,000 of cash dump in on top of the premium. Is that what I'm hearing you say?
Correct.
Okay.
And that's exactly right. So let's just say it's 10, like you said, 10, another 40,000. And then they decide they want to put another 50,000 or 100,000 of one time single premium paid up additions. And it's possible in many companies to do it like that. However, if you understand the MEC laws, Once again, that single premium is not going to buy very much in the form of a death benefit,
Because it's
but it
PUA.
because it's PUA, it's a one-time premium. Okay, so I tell people think about it like this: you're just going to an insurance company with $50,000, and you're saying, insurance company, I don't want to make any more premium payments. Okay, so here is $50,000. How much permanent death benefit can I have so it will never run out and I only have to make that one payment? Well, because it's just the one payment, they're going to then at different ages. Example, we were doing this the other day. If you're doing it for a 30-year-old, they may get 3.5 times the actual premium, which technically is an PUA premium because it's one time paid up additional. Paid up is key. And so you might get 3.5 times. My father,
Three and a half
which is
times.
not
You
a
mean the death benefit is 3.5 times the premium you put
correct,
in, right?
very
Okay.
good. Thank you. Right, thank you. My father, on the other hand, when he was making paid up additions at age 75, he because he's so close to mortality, they believe that they're not going to have that money very long. Now he's only going to get about 1.2 times death benefit for
Okay.
his PUA. So in order to overcome that, then for the MEC limit, it's a situation that people do not understand when they ask this. In order to be able to put in the normal a normal split of whatever you said, 25-75, because you said 10,000, 40,000 base. And I shouldn't say normal. I'm just saying a split of base
Mm-hmm.
and PUA. In order to put another PUA in, which a single premium is just another PUA, that's more cash value. So if you're going to have a death benefit for the first 40,000, the MEC limits are going to say it needs to be this big. Now you put another 50,000 in the 1 year rule. Guess what has to happen to the death benefit? It has to go way up because the MEC rules say it has to support 90,000 in this first year. Well, you're not changing the base of the original premium. You're not changing the PUA of the original premium. And the single premium doesn't buy very much death benefit.
Mm.
So guess what you have to do to the term rider? You have to put a much bigger term rider on it
To increase the death
to
benefit.
increase the death benefit. So what ends up happening now, and these gurus that think they've figured this out, they say, man, that's a lot of term cost that comes in. It might triple the term costs. And of course, it's early in the contract, so that term then doesn't go towards the cash value. So what ends up happening then is that is that is cash that doesn't start to compound early on because there's a drag for this much bigger term.
Because
And
term is purely a cost. It's not going, the premium you pay towards term doesn't convert into cash value at any point.
correct. And so what the gurus then said, oh, well, we'll solve that. Instead of doing 20-year term or a 30-year term, we'll
Mm.
just do a 10 and in some cases 7 years. So see how smart we are. I'm sorry, my sarcasm is coming through, but see
Just a
how
little.
smart we are. We figured out we can reduce it. Now it still doesn't reduce it by the same amount, but it does reduce it drastically. And so now you can put that in. It doesn't have the early drag. However, now you get to year 7. You still have this huge uh, term death benefit. It doesn't cost very much because it's only for 7 years. Now we come to year 7. Guess what? That term rider falls off. Now they have to recalculate the MEC limit because anytime there's a material change in the contract, they recalculate it. And you're not going to be able to put in the full premium in most cases because you don't have enough death benefit to continue to put in the regular PUA. Oh, and guess what? Right around year 7 is the time that the early costs in the contract go away. And what are those early costs? Underwriting costs, actuarial costs, home office costs, commission to the agent costs. There's all kinds of these early costs that get absorbed in the first few years of the contract. And now you still have the cost of insurance the entire time. But remember, the cost of insurance is spread out equally throughout the whole life.
Mm-hmm.
Now, all of a sudden, all those early fees are off of here. So now you have a very efficient, every time you put in premium, you get a more than a 1-to-1 growth in your cash value. But now they tell you, oh, you can't put in your PUA anymore because you don't have enough death benefit. So now you're only going to be up put the base. Your cash value still grows pretty well, but
Mm.
now they're going to tell you, instead of putting in, you said 10,000 and 40,000, the original 50,000, which I think earlier I might have said 40,000 total premium, so I apologize.
It's okay.
But now you cannot put that 40,000 in. And that 40,000 would have helped PUA. It would help the cash value grow by even more because it's very efficient now. And when you keep the cash value high early in a contract by even pulling down the base, which we're doing in this example, and this is part of the question, the dividend is affected by being even smaller because
Because most dividend is paid on the
most of
base.
the dividend and most products it's around 90% of the dividend is paid on the base contract.
Even when you
All
have a
right,
smaller amount of base compared to the amount of PUA.
correct. I mean, it moves a
Yes.
little bit, but not a
Mm-hmm.
lot. And it makes sense when you think about it because base is contractually obligated to keep being paid, contractually obligated. Now, there's ways to pay it within the contract, but it's still going to get paid in the contractually. So you're going to get a lot more death benefit for that because you're going to continue to get more premium. Where every PUA payment is you're not obligated to pay it, you can pay it. So think about the chief investment officer at an insurance company, they can take the base premium and make long-term commitments in the bond and fixed income market. The law under normal economic conditions, you're going to have much more return in the bond market the longer the duration is, the longer you go out. So they're looking at that as being, then you can have a bigger dividend on the base contract. This is not foreign economics. This is basic economics that people do not understand how insurance companies work. So then that means if they don't know, one, if they don't know they're going to get the PUA, and even if they get the PUA, they're like, well, we have to keep this fairly liquid because the PUA is going to have a lot of cash value. We got to have the ability to give that cash value back either directly as a withdrawal or we
Through
have to
loans.
borrow against it as a loan.
Mm-hmm.
We have to have liquidity. So in order to have liquidity, you have to have short-term bonds. So short-term bonds or even cash are
Mm-hmm.
not going to pay as much as the long-term bonds. So that's another reason that you're not going to be able to get much return as far as a dividend on
So,
PUAs.
so the insurance company has to take less risk on their investment portfolio in order to be able to make good on their promise to provide loans against your cash value. So the more cash value you have or policy owners have, the more short-term or cash the insurance company has to hold, meaning not as much growth, meaning not as much dividend. Bruce, I have an interesting follow-on question, and you maybe this is relevant and maybe it's not. Would it be possible to do a lump sum or a single premium that's all base? And would that work?
Okay, so let me get to that for just a second. But before you, I want to clarify for economic purposes so people understand. So that's called duration risk.
Mm,
Is okay. So um, insurance companies are highly regulated as far as how much they have to have reserve and liquid. So if they so they're going to be regulated, and they're going to be looked at how their portfolio is has duration risk. Where a bank, this is where the Silicon Valley Bank got in trouble, and a couple of these other banks got in trouble this year. They weren't as highly looked at because they're regulated by the feds rather than by each state. And so they don't get the same kind of scrutiny, and they don't have the same kind of scrutiny as insurance companies do. So it wasn't that security, or excuse me, Silicon Valley Bank didn't have the money. They had it locked up in long range duration bonds. And then when people had to run on the bank, which would be similar to people asking for withdrawals from an insurance company, or in most cases, asking for a loan from their insurance company. So people wanted their money back from Silicon
Mm-hmm.
Valley Bank. They had the money, but they had it tied up in long duration bonds. So in order for somebody to take that bond and buy it from them to give them liquidity, they weren't able to do it because the bond prices had gone up. So the bond values had come down. And so they didn't have enough book value for that. If they would have held them to maturity, they would have been fine.
Mm-hmm.
And that's where the regulators came in and said, okay, we're going to give you liquidity here right now, but now we have to take over these bonds in the long run. They put
I
them up as
mean,
collateral.
yeah, that makes me think of a person who's, you've heard the term broke millionaire, but somebody who has a lot of assets, but it's tied up, it's not accessible, it's illiquid. They have a need for accessing cash right away, but they can't get to the cash. They have plenty of net worth, but they can't liquidate assets quick enough to be able to make a payment on something. And so,
Yeah.
I mean,
So,
that's basically what was going on with
yeah. So,
Silicon Valley Bank.
I mean, people often refer to farmers as being, you know, land rich, but cash flow poor in the
Hmm.
same situation. So you ask about the base premium being, now remember, they're going to continue, if you do all base single lump sum, they're going to continue to want a
All
base
base.
premium. Yeah,
Yes.
continued. Now you can surrender part of the base PUAs, which would be in the form of a dividend that buys in PUAs. Because when you have a base, you get a dividend, and the dividends are set to buy PUAs. You're not just going to have all base the entire contract. The next year, when you get a dividend, you have a PUA. And so you can surrender those base PUAs to pay for but you're not going to get enough surrender to pay for the base premium because the death benefit is so high with the base, and it's not as high with the PUA dividend that's
Okay.
buying PUA. So
Yeah, sure.
it's really not any different.
I could just see that follow-on question, so I wanted to ask that. Okay,
Yeah, no.
so
Okay.
we had a similar question. I'm going to jump down one, Bruce, on what we had listed here. So, what do you think of custom whole life, which we're going to probably clarify what this person means along the way here, or paid up whole life insurance policies as opposed to payable your entire life? We asked for more clarification. They said, for family banking purposes, does the Money Advantage, do you guys tend to suggest shorter pay periods on whole life, or do most of the clients benefit from an ordinary policy? And so, Bruce, I'm going to let you just take that one and answer
Yeah.
directly on that.
So let's think about this from the guidelines or tenets that Nelson Nash put in place. Think long term. Don't be afraid to capitalize. Don't steal the peas. Don't do business with banks, and rethink your thinking. If if the banking function is always going to be in your life, then why would you use an extremely short pay policy?
And let's just
Because
clarify, if you're not familiar with this, banking function means you need to access capital somewhere. Usually, we just put our money in the bank. We think we'll just access capital from the bank if we need to access capital. Instead of that, we're barely earning any interest and we're having to pay interest to use the bank's capital. Instead, reclaiming the banking function is storing capital where you're earning interest and dividends. You're earning because it is in your control. And then you're in a position where there still is a cost of capital, but you're not interrupting the compounding every time that you're using capital?
So the short answer is if paying your entire life up to age 100 or 121, whichever companies do it like that, um, when you're spreading out your entire life, that means the premium would have to be different for mech situations, and the base would probably be smaller, so you're not going to get as big a dividend early on the compound. So if you're purely looking at it from a cash value standpoint, then you probably won't accumulate as much cash value early, but you then are going to say to yourself, but later on it's going to become more efficient. So wouldn't I want to be able to pay as long as possible? So we don't take a stand on this other than to explain people those pros and cons. Our base our base product that we like to look at first is a 30 pay product for 30 years or to age 75, whichever is longer. So if you're a newborn, you can pay for 75 years. And you probably would want to because you're only going to be 75 years old. So I don't care what kind of scarcity mindset you have. You might say, well, I'm going to probably be working till I'm 65 anyway, because that's the reason why most people want these shorter pay things. Because they're like, well, I don't know how I'm going to pay my premium after I stop working.
Mm-hmm.
And we say, well, are you going to stop financing things after you stop working? Or think somebody that's in age 60 for this particular product, they can pay for 30 years or to age 75, whichever's longer. So they can pay to age 90 for the base. They cannot pay PUAs after age 70, after age 75. So there's an art to this, but generally speaking, I would say you would want to pay the premiums as long as possible relative to your mortality. Okay. So there's an art to that. But I think what they're mostly saying here is, hey, we want to stop paying premiums as soon as possible. And there's the confusion, Rachel, because in Nelson's book on equipment financing or on um, uh, paying for cars, he
Mm-hmm.
shows the capitalization for 4 years.
Mm-hmm.
But then if you turn the page and go to the next one, it actually shows him paying for 4 years, then using it to buy the equipment or buy the car. He says if the insurance company is paying you 5%, charge your or not paying you, charging you
Charging you
5%
interest on the loan. Yes.
interest on the loan, which they do, just like a bank would, charge yourself 10%. The extra 5% now becomes your premium for year 5, for year 6, for year 7. So you're paying back the loan and you're paying additional premium. So even though it shows short pay in the book, you're not really only paying for 4 years. You continue to pay. We get this a lot because we look at people's full financial picture and figure out how much can they actually pay comfortably for that entire time. Then they borrow against and go do some banking. And they're like, well, I'm just paying the interest back. I want to pay interest back to myself in the form of more premiums, but I already have the premium payment. And I said, yeah, I know, because we wanted to make sure that you maximize the contract because the human condition gets in here. And if you can't maximize the contract, then yes, you could pay extra as far as additional interest, which it says that I think on page 52 at the bottom, all additional interest is more premium.
So just to clarify,
So
what Bruce is saying is if for any reason along the way of your life of your whole life insurance policy, you did not pay the full premium, then you have this extra space to pay more interest on your repayment of loans, which would be then filling up the premium that you didn't already pay.
yeah.
So, Bruce,
And before we go further, Rob just asked a question. He's a he's
good.
he's a longtime listener. He says reclaiming the banking function is all about one's understanding. What are the best ways to grow that understanding about money and banking
Mhm.
beyond BYOB?
Becoming your
Seeing the
own banker is what
problem,
he's referring to.
yeah. Seeing the problem is often the challenge. Rob, um, beyond BYOB. So I presume, Rob, because you are a longtime listener and you actually understand the concept very well, I presume what your meaning is you're already reclaiming the banking function by having a properly structured whole life insurance policy that you're using to take the banking function as far as financing out of your life. And maybe you're using it to store capital for other investments in the future. Maybe you're you're using it to for an emergency fund, you know, but really what you're trying to do is replace the banking function in your life. You said, what are the best ways to grow that understanding about money and banking beyond BYOB? I'm a little confused because you said about money and banking, but that's what BYOB is. So I think what you're saying is, are there other situations that a person could understand this? And I would say yes. The number one thing to understand is getting the banks out of your life by actually paying cash first, as far as having the discipline to save before you spend is not the best way, but it's certainly better than borrowing before you save. And that's what happens
Borrowing
when
before
you
you spend, you mean?
no,
The,
actually
oh,
what
okay.
well, no, actually what I mean is borrowing before you save, because that's what
Okay.
most people do. They borrow and then they save by they take in the extra money and they pay down the loan,
Okay,
which
yes.
is the extra money they would have had if they would have just saved it in the first place.
Yes.
It's funny how people can find $600 a month for a car loan that they didn't previously have, but they didn't find $600 a month to save. And I see this all the time when people reach out to the Money Advantage, because we ask them about how much they have their savings, and then we also ask them how much do they save every month. And people with, and I'm saying this happens, and I don't want to try to exaggerate, but I bet you it happens over 50% of the time. A person will say, we save over $1,000 a month, and then they have $1,500 in their savings, because you have this spending creep that comes on. Yeah, you might be putting your savings account,
And then
but
pulling it out next month.
you're spending it.
Yeah.
Well, but what happens is now you have a $600 car payment. You can't pull it back out, so you're paying it to the bank all the time. So that's what I mean by you're actually taking your money that you could have been saving first. You're actually getting a loan first, and then you're taking your savings and paying back the loan with your savings that you could have been doing. So
Bruce, I think
that's better than saving and paying cash is better than taking a loan and paying the loan back.
Bruce, I
Still
think
not
what's
the best way, but
yeah,
it's better.
I think what's really interesting about what you're saying is that it's really hard to put the discipline on yourself to save because you're the only one you're accountable to for that. If you say to yourself, I'm going to save 1,000 a month, and this month you save $2, and next month you save $4, you're not going to feel very good about that. But you also don't really have to answer to an outside financial agency who's going to reduce your credit score on the account that you didn't discipline yourself to save the amount you said you were going to save. But if you have a required payment, a fixed expense by the from the bank or from the auto finance company, and they say you have to make this payment or we're going to ding your credit, we find a way to have that outside accountability force us into making that payment. And so what you're saying is that instead of requiring that outside accountability, use the internal accountability to require yourself to save first rather than waiting for somebody else to force you
Yeah.
to make your monthly payments.
And if you have to fool yourself, because we fool ourselves in all kinds of things because we understand the human condition. If you have to fool yourself, I always say that one of the best things to do is have a separate account. My wife and I have done this for 40 years. And I know you and Lucas do this too. We actually save first before the money goes into our put and take account. And the way we did it when we were both W 2 employees And she's for the most part, she's been her W-2 employee. She has a consulting firm now, and she had a consulting firm before, but mostly we would take direct deposit and we would say, this is how much is going into our operational account to pay the bills. And this is how much is going to another account that is our savings account that is then going to go to our premiums, our opportunities, our investments, so on and so forth. And I've actually taken it one step further. I've actually set it up in another bank. So I could, obviously I could spend it from the other bank, but I pay my bills on bill pays from this bank. I can't easily take that money from another bank and put it in this one so we can use our debit cards or pay bills with it.
Mm-hmm.
So, Rob, I think that's getting control of that about money is the most important thing. Because if you don't have that, then you're not going to have premium payments. See, some people, especially the debt elimination people that use whole life, they say, well, look, see, people find $600 to pay for their loan payment. So now they don't have any discipline right now. They don't have any savings. So now let's just retake that $600 and let's start a policy first because you're paying loans now. But remember, a premium is not a loan. Okay. You're going to have to keep paying it. And what I found, Rachel, is people don't have the money now to pay the loan and they don't have the money to pay the premium. So we always say we don't use this to get out of debt because the human condition is too strong. You have to prove to us that you can actually save money first, and then we will start a policy.
I think so. I'm just going to add my thoughts on this really quick, and I'm going to try to do it in less than a minute. But this idea, Rob, I think you're asking a really good question because for somebody who's not at all familiar with infinite banking and has not even considered pursuing that as a solution to something, you're asking what are the problems that they have before or for which they would turn to infinite banking, I think is what you're asking, Rob. And these are the kinds of questions that I think about often because we are hoping to reach people who weren't aware of the infinite banking concept with the idea that there is a really positive solution that would work for them. And so I think Bruce's line of thinking is exactly what is needed. First, if somebody can value capital enough to have the ability to save and then pay cash for something, you begin recognizing that I need to delay gratification in order to build up this cash, and I need to plan ahead so that I have the cash to be able to make the purchase when I get to that future date that I decide I need to buy something. And so you're disciplining yourself all along the way. The challenge or the limitation of using cash is now at the point where I get my cash and I say, okay, well, now I'm going to go use that $30,000 or 25 or whatever you're using to go buy a car. I'm going to take it out of my account. I'm going to go I'm going to hand it to someone physically and say, here, now I'm paying for this car. I'm going to walk away with a car. There's power in having paid cash, but what you also are going to feel the pain of is I didn't earn very much on this cash while it was sitting in the bank all along the way because the interest rate was really low. And secondly, I just took out my ability to earn uninterrupted compound interest. I took that cash out and now my account is down to zero again. And what was it for? All I did was waited. The date that I made the purchase was later. That's the position you're in. You didn't pay interest to the finance company, so that's kind of a win, right? You you had to wait to make the purchase. That's a pro and con, if we're going to talk about it in that perspective. So I've got one thing going for me that I didn't pay interest. I have one thing going against me that I had to wait to make the car purchase. The real truth is, though, you are always paying interest because you gave up the whole time you were saving up that cash in your savings account, you were giving up the ability to earn interest. And the minute you take that cash out of your savings account and put it over into the asset purchase, you're in a position where now you have forever restarted the compounding curve on your savings account, which is why nobody really tangibly experiences the power of compound growth because real compound growth can't be interrupted. As soon as you stop it and interrupt it, you start back at zero again and you go through that really slow beginning point of the compound growth curve and you never feel the power of the 100 years or 200 years of growth that always kept stacking up. And so I think that's the first part to understanding the reason for reclaiming the banking function, because then you realize if I can keep the cash, never have to give it up, never have to interrupt the compounding, and it can earn better than what I'm doing in the bank, but I can use this cash somewhere else. Now I am the banker because I have this capital in my control. I think that's the way my mind works towards
Yeah.
recognizing the need for a solution.
The only thing I would add to that, you don't even have to make more than you were making in the bank because you're not interrupting the compounding.
Yes.
Yeah. So Leroy just had a couple great comments. But the last one, he says, whenever I talk about compound interest to people, it doesn't seem like they actually grasp it as a real thing. And Leroy, I think this comes down to the human condition again, or Parkinson's law, um, to be more specific, because Parkinson's law says that expenses rise to the amount of income you have, so people aren't experiencing this, and because probably Leroy, what people can't feel because compound interest does not feel very good early on when you're doing it.
It's boring. It's
I,
slow. Yeah.
well, I think I made this comment on the podcast before. When I used to be a biology teacher, we would talk about single cellular organisms with the class. And these were smart young men, seventh graders. And I would say, okay, you have a single cellular organism in a petri dish. And I also use lily pads in the pond, but in a petri dish, and it would double. Now you had two, two became four, four became eight, so on and so forth. And then I would say, after 29 days, you would actually cover half the petri dish. And then I would ask him how many more days is going to cover the other half. And it was amazing to me how very few people would say one. Most of the students would say 29, or they would say, I don't know. And it's the same thing for the general public. And I always say, and this is the general public is not economically sound because we don't teach this in schools, and I have a hard time with that because I'm not sure a government that has 30 at the time of this podcast has $35 trillion should be talking and are teaching anything about money
No, because
because of that.
if we model what they're doing, we would clearly also be a gigantic amount in debt.
Right. So yeah, Leroy, you beat me to the punch.
Yes.
He said about Penny. Would you rather have $1 million if somebody gave it to you, or would you like to double a penny every day for 30 days? We're not going to give the answer. People go figure it out. It's really really eye opening, and I actually draw a line, a compounding line curve that starts out slowly, and then I draw a line right at the 50% mark, where 50% of the lines on the left hand side, 50% of the line on the right hand side. And I ask the clients, which side of the line do you want to be on? And they all say the right hand side because it goes really steeply up. And I said, but the only way you can get on the right hand side is by being patient on the left hand side. It's the only way. Because if you interrupt that one time, then you've actually interrupted the compounding.
And
That's true
started
comp
over and
and
gone
started
back to
over.
the boring, slow side of the compound line that nobody wants to be on.
And we're going to be doing this more and more. We're going to be bringing more and more practitioners that we work with on. Joe DeFazio has actually showed this to our mastermind group, where what people think is S&P 500 compounding is actually false compounding, because even though the line goes up in a curve, it's always resetting. It's always resetting. So it takes longer for it to actually go up. So it's not true compounding. But yet we always talk about the compounding effect of the stock market. Um, so that's why even a lesser amount compounding that's not interrupted can actually do better than a greater amount that keeps being reset by interrupting the compounding.
Or by losing value. So My goodness, this has been a really fascinating conversation, Bruce. I think the next place to go here is what here's a listener question, and we're not going to be able to get through all of these today, but what would you say is a good policy to start? And the reason I think this is the next ideal question is if you're in a position of saying, okay, well, I've got a big lump sum right now and I want to get that into a policy to get it working as quickly as possible. We've answered already why you don't want to just make a lump sum payment. Instead, you want to have a longer funding plan because you want to be in a position that you're going to have a less likelihood of mecking the policy and losing your tax advantages. You also want to be in a position where you have the ability to continue funding it when the policy becomes most efficient on the other side of that compound growth curve line. Then we talked about um, custom whole life or paid up shorter or ordinary policy where you're going to pay as long as possible. And we talked about the value of funding as long as you can. So in light of those things, now we're coming into a question that maybe the listener who asked this was thinking about those things, or maybe they were thinking about something completely different. But as they're saying, okay, well, I do want to get started. I want to start reclaiming the banking function. I want to think about my financial picture accurately. I want to think about my cash flow properly. I want to not commit to more than I should, but I don't want to just start super tiny either. I don't want to just short fund something. I want to commit long term, but I want to leave space for the fact that I know that I'm probably going to add policies in the future. When they're saying, what is a good policy to start? I hear in that question, I'm wanting to get started with a system of creating infinite banking in my life. At some point, I'm probably going to be adding policies and maybe adding policies on different people in the family. And so, how do we think about most advantageously the whole concept, the idea that the best time to plant the forest was 20 years ago. The even better time is to start now, and knowing that your life is just going to continue getting better and better and you're going to have more capability in the future. How do we get started with the best kind of mindset and best policy today?
Yeah, it was very good. You just said with our life getting better and better. First of all, this is only going to work if you have an optimistic mindset, an abundance mindset, because if you have a scarcity mindset, like I'm never going to make more money than I may make right now, probably shouldn't do it because you're going to always be afraid. I've had some people say that agents have said to them, well, we want to make your base premium what you can pay. We're not sure you can pay the PUAs, but we'll set it up so that the base you can pay, and then we're going to stretch you with the PUAs. I think that's dangerous because it can work. There's no doubt about it. It could work. But what you're saying is that you're going to rely on people overcoming the human condition and putting every other penny they can into the PUAs. But what I found over my career, people don't stretch themselves. They don't put everything they can into the PUAs. And so then what ends up happening is they only fund the base. And guess what happens? It takes the base a little longer to gather momentum to gather and produce enough cash value where people think it's worth it. Now, cash value in my mind isn't the only thing that's worth it. It's the death benefit also. So I would say where's a good policy to start? Rachel already hit it. It's better to start sooner rather than later. We believe, and we say this all the time, is if you're not confident, then get started with something small and see how it works. Be comfortable with it, and you can add policies later on. What we often also do is we will add a outside term policy that can be converted into the future. And that way you can say, well, I need the death benefit to get as close to my human life value as I need or want. Those are two different things too. Um, and then if I understand it and I have more cash in the future, all I have to do is convert the term either partially or all to another policy. I did that 4 years ago with my wife. After 20 years, her term was falling off. and we didn't want that death benefit to go away. Plus, we had more money, so we converted it to another policy. But we've been doing this since the '80s, and my father started it in 1963, and his was $25 a year for me. So I would say that just getting started was very advantageous.
Hmm.
So I would just say that's a good policy to start. I don't know. I see. We're always comparing this. We're thinking, oh, if I go to the Money Advantage and they give me a policy design, then I take it over to another company, they give me a policy design. I take another company, they give me a policy design. They're always comparing designs. And behavior is much more important than design. And I'll give you an example. Drive down the street, look at every bank and credit union, and they're all going to offer you different interest rates on their savings accounts and checking accounts. They're all going to different ones, because I see this every day when I go over with my clients. Oh yeah, I have a money market account that's paying 3.5%. The next client that comes in, money market account that's paying 3%. Another client comes in, my money market account's paying 4.125%. Well, there's still trillions of dollars saved in all these different banks, even though the return is different, because there's other things that play into it. Convenience, what other offerings they have, benefits they have at the bank. It's the
The
same
relationship,
thing.
yeah.
Relationship, very good, Rachel. The relationship you have with the bank. So I always say, just get started. The most important thing is your behavior. And then when you're not looking for a design, you're looking for a partner.
Hmm.
Which is the best insurance company to partner with? And we tend to do business with, number one, the companies that support the Nelson Nash Institute. Because when they support the Nelson Nash Institute, what ends up happening is they design their products that are very favorable to our clients.
Hmm.
Number
And you don't mean
two,
like paying the Nelson Nash Institute. You mean being okay with the idea of banking and using the banking concept.
yeah, but they also show up to the annual think tank
Oh, that's,
that Nelson
yes.
Nash has, and they set up their little booth. They have communication skills. They tell people, "Oh, we're glad to have you." They want more business, so they're going to design products that work
Hmm.
for them. So on and so forth. And they show their support by sponsoring the table, sponsoring lunch, so on and so forth. Then you have the other ones, which people are in love with in certain, what they call the Big Four out of New York. Not one of them support the Nelson Nash Institute. Matter of fact, we know that one of them, even though they have a product that can do what the Institute talks about as high PUAs, they tell people don't use the product because we don't want people borrowing early cash value in this situation. And then another one of the big fours, they actually ding their upper management if they have too many loans out. And I know that because we have agents that have moved from them because of that. So really, Nelson Nash Institute, because of the support, products, and number two, I would look at the ones that have set up their operations to actually do loans and pay them back as easy as possible, because you're trying to insurance companies aren't banks. We want to make this very clear, and they make it very clear to people. But we're going to utilize them for the banking function, the borrowing and saving, just like you would do in a bank. And so that's the customer service. And then the final thing, I think they need to be a highly rated company,
Hmm.
a company that's at least in the top 10 of the ratings system. And the rating systems you can take with a grain of salt a little bit, because they were part of the cause of the financial crisis. Not so much with insurance companies, but some of the same ones or rating both. So those are really the three things that I think you should consider with what would you say is a good policy to start? It's behavior, and just get a policy going with one of those companies that support the Nelson Nash Institute.
I think this has been really fun today and hopefully really insightful and eye-opening for you if you're listening. We will have to have more episodes that we cover your questions. We have more questions that we plan to cover today, and we are out of time. So that's going to be all for this episode. But a couple of things that you can do if you have questions that you'd like us to cover on the live stream, you can jump in any Wednesday at 10 as we're usually doing our live conversations, and you can ask your questions in the chat. You can also email us your questions at hello@themoneyadvantage.com. You can also just comment on any YouTube video that you see, any Facebook post that you see where you're listening to the podcast, and be able to just ask a question and we'll be able to address that in the future. We usually go ahead and answer those on the comment format and feed, but we also like to make sure that we bring them to a public forum where you can really hear a little bit more nuanced answer rather than just what we're able to communicate via text. I do want to let you know that upcoming, and this is something you can look forward to, we plan to have more of an opportunity for you to ask your questions even on a live situation where you're able to speak and ask your questions and be able to get a deeper understanding of what is on your mind regarding infinite banking and finance and money and cash flow and personal finance, business finance. And so we're going to be doing webinars in the future. And so you can look for announcements about that if you would like to participate in that, to just be able to continue to grow your understanding of keeping and controlling your money. We'd love to be a part of that journey for you. So in closing, please remember success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.